Welcome back, viewers. This is your instructor Sayyid Zaki Ahmed. Assalamu alaikum. Today our topic will be cost of capital. Please do listen to this lecture till the last so that you get a full good understanding of cost of capital. Cost of capital basically is the cost which we have to pay for getting money from other investors. Whenever we start a project, sometimes we make take out the money from our own earnings or retained earnings, savings, or sometimes we borrow it from outside in form of debt. Similarly, we can get some issue some shares to get some more capital. So all these things will be discussed in detail in this lecture. Please subscribe my channel if for getting future advanced lectures. I'll be waiting for your comments. Viewers, now this is my financial management lecture number 6. This will include cost of capital, cost of debt, cost of stock, and cost of preferred stock in detail in the coming lectures. Now let's discuss the capital structure of the company. The, any company needing to invest somewhere needs money. It can arrange either of these three ways. The issue of shares. When they issue share, they take money for it. Secondly, they use their retained earning. The cost will be the same as the issue of the shares because the shareholders are expecting money on that retained earning also. Issue of preference share and taking a loan or bonds. Taking a loan or debt is one of the cheapest way of financing in these three of these. Viewers, let's discuss cost of capital now. Cost of capital basically it is the return expected by the lender who provides capital for this business. For the investor, cost of capital is the amount of risk he is taking by giving the money. The risk can be either the borrower will not be able to pay the money back or pay the principal back. All these risks are involved in there. So the investor always wants his money in a safe place and will charge the company a cost of capital that will exceed the cost of his cost of money, thus generating return that are proportionate to the risk. The company using capital cost of capital is the opportunity cost of making a specific investment. So viewers, that's coming back to our cost of debt now. Cost of debt is very simple if you see. Basically, you can just whatever the lender is charging you can put that onto your cost, whatever return he is asking you. But there is an edge you get in the tax. That tax rate basically is deducted from the profit, so it gives you less taxation because the profit is reduced. You can see here in this slide, I shall give you through a pointer. Now, see in company A that there is that. Now, simple profit and loss, we get 50,000, 50,000 both of the companies. This is a debt company, this is a no debt company. Now in the debt company, you see this net profit after interest. When they deduct it, it comes to taxation comes to 16,000. Similarly, without taxation, the profit is higher, so the tax is also higher. So you make a little edge here, a little benefit on your side of about 4,000 if you have interest here, interest payment, because your net profit is reduced. So your tax is saved. So this benefit is taken into account in the cost of debt. So our formula becomes after tax cost of debt is cost of debt multiplied by 1 minus tax rate, because that tax is already deducted here and you are already getting a benefit here. So the cost is reduced here in this condition. Now coming to bonds, one of the major instruments dealt in the businesses is bond for debt purposes, which is very secure medium and normally it is cheap also as compared to other mediums of capital. Now, if the bond redemption can be is mainly dependent on the terms of deal dealt in the bond. So, if in the deal the bond redemption means when the money will be returned, redemption is called when the money or principal amount will return, irrespective of the cost, which will be continuously paid every year for how long it is being kept. The principal amount at a certain time has to be returned. The time is called the redemption period, and if the bond is returned with the principal value the same as it was received, that is called at par, so it will be called bond redemption at par. That means the money received and the money returned will be the same. Similarly, there can be a situation in a deal where the bond is redeemed at a premium. That means the principal amount returned at the end of the redemption period will be more than the money received. This situation is called bond redeemed at premium. Similarly, the bonds can be redeemed at discount, meaning that the principal returned at the end of the redemption period is less than the amount received. The interest on the instrument will be charged irrespective of these redemption charges. Now, this redemption of bond is here discussed here. The cost is also discussed here. Does it cost to the person redeeming the bonds? Now, these are the examples here. Let's say the bond is at premium. Let's say it was 100 rupees, and we at the time of redemption we had to give 105 as the principal. So we pay back 5 rupees more at the end of the Retention, redemption period, apart from the interest cost. Similarly, sometimes we return that discount means the return is less than the received value. E.g., bond of value rupees 100 when redeemed will pay back 95. So an advantage in this cost of rupees 500 during the total time period held. So our formula for this redemption costs and everything inclusive now becomes, let me put my pointer out. Now let's say A is equal to interest multiplied by 1 minus tax percentage. This is the adjustment of the tax interest on interest plus redeemable capital amount received divided by the redeemable period, that is number of years. So in technical terms it becomes interest multiplied by 1 minus tax percentage plus RC plus B0. B0 is the value of the bond at the time of issue of these bonds divided by the N. N is the number of years bond is kept. So, and now B is the average cost, which is taken out like this. Redeemable capital plus B0, yeah, that means the value at the time of year 0 divided by 2. This is the average cost. Now debt cost will be A by B multiplied by 100. Now as I discussed the three types of capital in a company, normally the other two we discussed now. The debt I have discussed already. Now the other types of stock is generally referred to as stock and the ownership or equity of a firm. These are two types normally, the common stock and the preferred stock. Preferred stock holders have a stronger claim, higher claim to dividends or asset distribution than the common stockholders. The details of each preferred stock depends on their issue and their terms. The preferred stockholders have priority over common stockholders when it comes to dividend. That they are always paid dividend whether the company is making loss or gain. Their cost of preferred stock will always be paid yearly, whereas the common stockholders sometimes that do not get any profit distribution if the company is making a loss or anything. But preferred dividends have the right and they get profit everything whenever every year closes. Preferred stock dividends are also called the preferred stock cost also. They are like any debt payment, but they are paid from the profit after tax. So our preferred stock dividend or cost is paid out of profit after tax. So our formula for the cost of preferred stock is the same as the as bonds cost, but without tax adjustment. So the formula becomes the cost of preferred stock is interest or dividend divided by the P naught. P naught is the amount received preferred stock. PS can also be redeemed at cost. That means they are redeemed at the amount same as the amount received. So preferred stock can also be redeemed at higher value than the amount received at the time of redemption, means they are redeemed at premium. Similarly, PS can also be redeemed at lower value than the amount received at the time of redemption, means they are redeemed at discount. So the formula becomes A interest plus redeemed capital plus amount received divided by redemption years, or in formula form INT plus RC plus P naught divided by N. Similarly, B is equal to redeemed capital plus P naught, that is the amount received at the beginning of the preferred share. So divided by 2, that means the average amount of bond money. So the debt cost becomes A by B, A divided by B multiplied by 100 in percentage. Now cost of common stock is taken out in a very little different way. Let's assume if you want to buy something for business or anything like that, you will ask for the price of any good you want to buy. Naturally, if you have two or three goods, you will buy which is economical for you or which will be more beneficial to you at the same time. So similarly here in the stocks also in the market, you have interest rate prevailing in the market. The banks are offering you interest and different also instruments also are offering. So whenever you put your stock in the market, naturally the stockholders will prefer a rate of return and will expect a rate of return from you that would definitely be higher than the prevailing market interest rate, so that they buy your stock. So your stock has to be at a rate of return which is normally comparing the market rates available in the market. Similarly, the common stock is generally issued with the same interest or anything like dividend policy, so that the stockholders get benefit out of it and as they compare with the market rate. So generally the cost of common stock is required rate of return. The companies can issue common equity in two ways: by issuing common stock, new common stock, or by retaining the reinvesting previous earnings. The two approaches are usually employed to assess the required rate of return. Let's take out the cost of the common stock. There are generally two methods of evaluating cost of common stock. Number one is the dividend discount model. We know the price of a common stock can be determined as the present value of the future cash flows, that is the dividends in future, to form a dividend. So the equation can be written as P1 equation can be written as the present value of the stock is equal to D1 divided by your required rate of return. Similarly, RS stands here as a required rate of return. So if we find RS, that is the cost of this common stock here, where in this formula D1, D2 and Dn are the expected dividends in future. P0 is the current market price of a stock which is available, and RS is the required rate of return, that is the cost of the common stock. Similarly, let's go to the next slide. If the company pays dividend for the lifetime of a stock and dividends grow at a constant rate also, the same formula will become modified a little bit. You see here present value of the stock D0 multiplied by 1 plus G, that is the growth, divided by RS minus G. RS is the required rate of return. So similarly we can say here D1 divided by RS minus G. Similarly here also D0 is the last actual dividend paid, D1 is the expected dividend, and G is the growth rate. So knowing the current market value of a stock and the last dividend paid, we can calculate the required rate of return, which is equal to the cost of common stock. If the company is going to raise a capital by issuing new stock, we should take into account flotation costs also. Flotation cost is the cost where for launching the new stock we'll have to pay the brokers and parties involved in between. So this cost of common stock required rate of return becomes D1 divided by P0 multiplied by 1 minus flotation cost plus G. So RS is the required rate of interest and F is the flotation cost. We'll do the examples in the next slide. Here, this is an example of the flotation cost also and the cost of issue of stock. So the same formula here is being used here. D1 is taken out here. D1 is taken out here, and you can see basically it is taken out by D0 multiplied by 1 plus G, that becomes 1.5. So the flotation cost also is there, that is what 3% and 5% flotation cost is here. So we put it in the formula. Here you can see the answer comes out to be D1 equals to 11.914 required rate of return. Similarly, we go to the next slide. Here we calculate by the second method, that is the capital asset pricing model. Everything is given here in the example. You see the formula here, capital asset pricing model is required rate of return is the RF, that is the risk-free rate plus beta multiplied by risk-free market rate minus risk-free rate. Here it is given here. The rate that is risk-free, that is without any, normally the state bank issues that kind of rate normally, that is risk-free normally. Beta is the beta coefficient of a stock, that is also given, and RM is the expected market rate. So required rate of return becomes here in this fashion. Let's do the example. You see this example is self-explanatory. We have three companies giving beta's coefficient here. We just have to estimate the cost of common stock. We employ CAPM model, assume the risk-free rate is 2.75% and expected market rate return is 14.7. So we put these values here and we get risk-free expected rate of return here in these three answers. That covers our cost of capital. Boss, with this I end my current lecture. My next lecture would be lecture financial management number 7, and it will include valuation of bonds, valuation of common stock, valuation of preferred stocks in the coming lecture. So kindly do see my channel for further updates. So students, I end up my lecture today. Bon voyage to all of you and best of luck. Kindly refer to my parent channel Mindbenders 172 for more of the knowledge videos, and subscribe if you are here for the first time. If you like the video, please press the like button given below, and don't forget to refer my channel to all your friends and colleagues. For all your queries, my email is here, and or contact my WhatsApp number for any further queries.